Hi there, this is Cynthia Fick, and this is your Monday Financial Life Planner Stock Market Update. So let's get started. As I said last week, I thought the Federal Reserve was going to raise the federal funds rate by 75 basis points, and it did. And to me, it looks like they're going to continue to raise the Fed funds rate. And here's why. Let me just share a screen with you right now. After the meeting last week, Jerome Powell came out and said that there's no sense that inflation is coming down. He said, we're exactly where we were a year ago. So I would also say it's premature to discuss pausing. And it's not something that we're thinking about right now. We're not planning on pivoting. We have a ways to go. Basically, hard stance on raising interest rates and inflation. He's sending a very strong message to the stock market and the bond market. And guess what? They're listening. So that's what's happening in both the stock and the bond market. So one of the reasons is there's a really strong wage inflation number that came out on Friday. And he's saying, this is why we think there's more inflation. The labor market remains extremely tight. Unemployment is at a 50-year low, but job vacancies are still very high and wage growth is elevated. So the labor market continues to be out of balance because the demand for laborers is substantially exceeding the supply of available workers. So that's what's causing this wage inflation, and that's what they're really focusing on right now. So not sure that's going to change very soon, but he's very clearly telling us they plan to continue to raise interest rates. So that's what we can expect. So why are they so stuck on this? Why can't they let it go? Well, here's a big reason why. They're looking at what happened in the 1970s. When, we all know of the 73, 74, inflation spike that we had. I'm going to make this a little bigger for you right now. And in 73, inflation was at 8.7%, and they took the federal funds rate up to 9%. In 1974, inflation was at 12.3%, and they took the Fed funds rate up to 8%. So then they started backing off, and you can see they lowered the Fed funds rate. And then what happened in 1978? Inflation came roaring back again. So this is what they're afraid of. This is what they're trying to avoid. At one point in 1980, the Fed funds rate went to 18%. So that's what they're trying to avoid. So bottom line is, it doesn't matter what I think. It doesn't matter what any talking head on TV thinks. It's what the Federal Reserve is going to do. And so if we look at how does that affect the stock market, and that is what I mostly care about for you. How is this going to affect us? And I'm going to talk about a typical bear market. I'm going to zoom in here just a little bit. Okay, so this is how painful is a typical bear market. And this is going back to 1929, so all the way through 2022. This isn't a forecast. I'm not saying this is going to happen. I'm just trying to show you sometimes looking at what the worst case scenarios is can actually help you feel better about things. So let's go back and let's look. The median bear market, and this one we can all agree started in January of 2022. Okay, so that's when this bear market started. And the median bear market with no recession is a 26. The average is 29% decline in the S&P. And guess what? That's pretty much exactly where we're at, okay, or have been recently. So that's what happens in a no recession bear market. In a all bear market, so this is the average, median, and average of all bear markets since 1929, the worst case scenarios were 29% and 36%. So this would lead us to around the 3,200. If that was to happen today, the average bear market was to happen today, that would put us, look over in this chart here, at around the 3,200 point on the S&P 500. And here we are in the 3,500 right now. So that's the downside that is potential if we have a normal average bear market. If we go into recession, it could get worse. But let's focus on what the market is showing us it wants to do right now. So we connect all these lines, we connect all these bottom lines, and it looks to me like somewhere in the 30 200 level is not out of possibility. Again, I'm not predicting that. I'm not projecting that. And again, that's why we have to stay open-minded, nimble, ready to move, because we could end up having some pretty violent swings in the stock market. Because, you know, the Federal Reserve is holding a hard line now, is trying to set expectations for the stock market and the bond market. I think they're paying full attention. The Federal Reserve has their full attention, because if interest rates start to come down, if the stock market starts to go surging up, that can't take away from what they're trying to do on inflation, because it ends up loosening the economic cycle out there, and that they want to tighten it now and control inflation. So these are all the forces, almost like the perfect storm we are having right now. But hopefully that chart is showing you what the potential downside is, gives you some bit of solace in this storm. So I will see you next Monday with more information on what's going on in the markets. Have a great week.